Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, September 15th, 2023. What I'm going to do in this video, oh, by the way, it's 2:04 p.m. I usually like to state the time just so you have an idea of where things are at in the charts. What I'm going to do in here is just kind of go over, like I often do, what stands out, and it'll be a mishmash. In fact, I did a video yesterday, and then it just ran so long, I kind of went off on some tangents, and I figured I'm looking at the near zero comments lately, so I figured everybody's checked out the market, and I talked about that. The market's been in this range, grinding around for 2 months, almost 2 months, almost to the day. It was, when you look here, that candle, that spike high right there, was on the 16th of May or June. I'm sorry, June 16th. And so yeah, we're 3 months going up a little bit from there. And if you look at that high on June 16th, let's just measure it out. And so where I'm going is, and I get it, I've done this long enough, people check out. It's also seasonality. It's kind of a year where things taper off, and people's kids are back in school, and so everyone's back from vacation. Okay, but so that's a whopping, less than four, right at from the highs, from that high to that high, 4%, and we went up 4% and down 4.77%. So you're in that 4 or 5% range, high to low, for the last 3 months. So if you feel frustrated, if again I speak to this, if you're giving up, then that's what the market does sometimes. And from these areas of consolidation tend to come some big moves. And so I'm doing the video now because there are some levels to watch. There's always levels to watch, but what I mean, we're getting closer to that. So here's that primary uptrend line in QQQ. This is my daily chart, my kind of go-to board right here. I have the clean version if you want to see it here, but here's that uptrend line I've been harping on forever and a day. It's the 2023 uptrend line, very well defined, off right from the beginning, right from the start of the year. And we have a lot of reactions to help validate it. I think it's technically significant. And then I'm going to tweak this line, the upper line. We do have now, remember I had a different trend line, downtrend line before, but we do have a new one that's pretty valid. You have almost a reaction there that comes off the highs, definitely a distinct reaction there. I just might have moved it a little bit too much. Let me put it down right there where I had it. Yeah, so that's our downtrend line from the highs. That gives us a triangle pattern. And so if we pop that, you still have pretty significant resistance, about 380.50 just above it. But again, a pop of that is going to, in my opinion, increase the odds for new highs. And even more so now, you have this little pocket or area of consolidation, sideways consolidation there. So traders are going to be focused on that reaction high, that candle there from the September 1st. So levels to watch. You guys know which way I think it's going. That hasn't changed. If I change my view, I'll let you know. Convictions still aren't super high. You just can't. You're in a triangle pattern, but there's a lot here that I'm looking at to like if you are bearish, currently short, or looking to get short. And again, the easy money, I talked about it in yesterday's video. Again, if you want that, I'll put a link in the comment section. Just let me know and I'll put it. But the easy money, or really in fact the only money other than actively trading QQQ, which I'll get to in a second, but for as far as swing and trend tradings, have come from individual sectors. I've been very clear on that. The sectors I like: stocks, commodities, and even then it's kind of been a little tough grind in the commodity area. We've had some hit and run trades on, we actually have done pretty well in wheat in the last few months, getting in the trends. I'll maybe touch on that one again. We've had at least one of the two stocks I put out in the last couple of days. Kara is doing very well. Almost hit that trend line, that first target today, and that might be it. So I'm going to speak to that one too. But this is it, guys. We're very close, and that's why I wanted to do this video. We're very close to taking out that trend line. This trend line, by the way, you can see I have it thicker than the downtrend line. This is much more significant. Why is it more significant than the downtrend line? Well, number one, it's longer. Number two, there's more reactions. Anybody, you can be third day into charting, you've never done technical analysis before, but you picked up a book or watch a few videos, and I think the first part of technical analysis, the most simple and really purest part of it, is just to be able to identify support and resistance levels. That's what is the huge part, the biggest part of my trading, whether they are horizontal price support levels like 357 right there, or whether they are trend lines, uptrend lines or downtrend lines. And where I was going is the more reactions on a level, whether it's a trend line or a horizontal level, the more reactions, especially over time, you have distinct reactions. You hit it and then move up, the more technically significant that level is. And to expand on that a little further, when a trend line or a support level is very obvious, if it's super obvious to me, it's going to be more obvious to the masses, because it doesn't matter what I see. I may be, in my head, brilliant and right on my analysis, but guess what? If I see something the masses don't see, a bullish or bearish pattern or developments, and the masses don't act on it, then it's not going to play out that way. So again, I want to, when the patterns and levels are very obvious, and yeah, sometimes that backfires if all eyes are looking at the same thing and expecting one thing to happen. Yes, there is some of that over time where it doesn't happen, or you get a fake false breakout. But again, that's getting a little too nitty gritty. Take a breakout or a breakdown for what it is unless it fails. So anyways, I just wanted to point out that we're probably, unless we reverse today, we're going to close on or around or in very close proximity to that key uptrend line. And that is one of the sell signals it's really the next sell signal I've been waiting for on the daily chart. Then after that, the not line in the sand, but the next level I really want to see go to make a case to be aggressively short and increase the odds that this was a significant top, and quite likely the top, the end of a bear market rally. That's kind of, been a powerful one, but it's nothing more than a bear market rally as long as we remain above the old 2021, 2022 highs. All right, let's not beat a dead horse. It is what it is, and if we go the other way, and as I like to say, support is support until unless broken. So if they can rally it up here, whether they get a false breakdown and a reversal or not, I gave you the levels to watch the upside. We may get that divergent high, marginal new high scenario. And to me, it's still a longer term bearish scenario. So I want to make that very clear. Only talking, probably a few percentage points, give or take, above the previous highs right there. And then anything much more than that, if we go up a lot more than that and these divergences are taken out down here, then I'm just wrong, and hopefully I'm making money somewhere else, because I won't be making it on the index shorts if that happens. Or maybe I'll be long at that time. Who knows? We'll see what happens. The charts are dynamic, and so is my analysis, meaning they change every single day. Well, especially when there's moves in price. Some days you don't have any change, and those are the days I usually go quiet if there's no, significant change. However, let's get to some other things, because it's not all about QQQ. It is mostly about QQQ. I've maintained that for many years. It's got the much higher concentration, the same top holdings that the S&P 500 does, but just in a much higher concentration. So it's like, and those are the ones that determine where the stock market goes. I'm talking about the Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, Meta, those guys there. And where they go, the market goes. It's just, let's make no mistake about that. All right, so what else happened today that's worth noting? SOX semis finally broke down. There's that same trend line that I've been looking at. Semis is not mere coincidence. It's very similar, but a little bit different than the NASDAQ 100, because the semis, like the S&P 500, the broad market bottomed mid-October. And that technically that's when the NASDAQ, QQQ, most of the FANGs bottom in the beginning of January. Oh yeah, so mid-October was technically the bottom, but you almost double tested on QQQ. But October was the low, but this is the cleaner trend line. And on the semis, that trend line is clean off the October lows. And this is, you don't have to squint and see, is that a breakdown? Yeah, that's a breakdown. That's what you want to see. I've always said, I make a lot of terms up in trading and investing. One of them is the redder the better when you see a breakdown, meaning the bigger the red candle is on the breakdown on a downside break. This is a bearish rising wedge pattern. That was a divergent high. This line, I extended it in case we had or still get. Maybe this proves to be a false breakout. I don't think it will be. Get a marginal new high. We could still go down. But either way, this is what it is. it is a breakdown until unless that fails. If it fails, that means a solid recovery and daily close back above the trend line. Anything else? And I'll just give you a level here where if you are short or added to some shorts today, there's a nice little resistance level right there. You have a gap. If you zoom in nice and tight, there's a gap right there. You have a reaction high. It's about 501. So this is where number one today is an objective add-on to really index shorts, because the semis buckle. Semis are the canary in the coal mine for the tech sector. Tech is what is the leading sector. It's almost over half, actually, of the NASDAQ 100. So where the semis go, tech is likely going to follow. And again, they are a subsector of tech. But that's a breakdown. So take it for what it's worth. And, if it does that, then that's where I think it'll be a false breakdown back above 501, so give it a little bit of room through there. But if that happens, they're probably going to pop it, then they run at that reaction high, and that's going to increase the odds for a marginal new high scenario. But as of now, the odds just ticked up today that this high was the high in the end of the bear market rally, and that we're going a lot lower. And I've had all along long-term targets on the semis, way down here. This is a primary bull market uptrend line on stocks that has yet to been hit. We reversed shy of it on that last drop there, and at minimum I think we're going to that, and ultimately I think we're probably going to take it out. So we'll see. Anyways, just wanted to point out the breakdown in the semis today. Watch the king of all AI hype and the king of all semis right now, NVIDIA, 440 right at support. So there's still a chance buyers, this is TA 101, buyers should, quote unquote, should step in here. If you are a bull and you're bullish on NVIDIA, then you were looking to buy a pullback, well, why didn't you, this is where you step in and buy. I'm not buying. I'd rather wait and see that level go just based on my outlook for the sector, but I fully acknowledge I may step in here and buy it. So it's not an all-in moment yet, but the odds tick up. These are my check boxes. Each one of these levels, and this is a really big one, are check marks for the bearish case. It means if the video breaks that, it's probably going down to my next stop there at 403.30. If it breaks that, opens the door for 375, then that's a big level, because that's that big gap that kind of just set the tone for everything we saw. After that, took the market up. All other semis followed. NVIDIA was deemed bulletproof at that point. It would just be a very big technical blow, but also psychological blow to the whole, I think the whole semiconductor arena there. And there's your uptrend line, longer term uptrend line. And, nothing's changed. I still have pretty aggressive targets. I'm probably the only person in the world that has these type of targets on especially on what is now considered the most beloved stock in the NASDAQ 100, even more so, I think, than Apple. It's not bigger in market cap. It just, again, kind of was stamped, from everything I could pick up in the mainstream media, is just, this is a stock you have to own. This stock is going to go up. They have orders. They raise guidance, blah, blah, blah. And that could be a generational top, the kind of hype that this stock had. Look, this thing's still right off all-time highs. So I don't want to get ahead of myself, but I just want to point out that, did call it down here from the beginning of the bear market. Laid out these targets back then. We hit T2 almost to the button. That's where we reversed. So this is how it works. Went down, hit my first target. We bounced. Then we took that out, opened the door for the next move down, hit T2, had a heck of a bounce, and my next stop is T3. Right now, that would probably, well, we'll see. I always say the charts are dynamic. I may eliminate T4 because that is going to be a pretty aggressive target. Although I do think in the coming years, it might be a year or more to get there. It will, I believe, go back there. Almost everything, I can't recall, and I've studied charts for many years. All these, you can go back to Apple and Amazon, stocks that were around for a long time. NVIDIA came on, looked like it came public back in the late 90s here, according to my chart. That's where 1999. But where I'm going is, when stocks have a very well-defined primary bull market, this is a secular bull market uptrend line. they tend to come and visit it from time to time. And it's been a long time since it visited. And usually, from my experience, the farther you get away from those primary trend lines, the more impulsive that mean reversion is, that move back down to it. And NVIDIA has a track record of coming back down about, well into the double digits, 90%, 86%, 56% on that. Those are the corrections following the divergent highs on the weekly. And so this one was, and again, we called that one, hit that second target. I remember covering all shorts there. Expecting a bounce even on the video. That was a 70% drop. I need to add that in there. So to drop now to T3, that would be an 85% drop, and really in line with these two back here. So just, it's going to happen or it's not going to happen. We'll see. And I know I'm probably very few listen to my voice care to shorten a video, and even fewer, at least at this point in time, even fewer believe that the stock can drop 80-something%, but we'll see. All right, what else do I want to cover for you? Oh yeah, let me give you an update on Kara. Time to take profit. We came close today. I took profits. I might even cancel these additional targets. I believe I talked about this one in the video yesterday. I've traded the cannabis stocks for years. Before they were all penny stocks when I started trading. In fact, it holds Aurora Cannabis, ACB, holds the unique distinction of being the first official trade. That was back in the days I used to put all the exact price targets. I would adjust them, meaning, if this, for example, if T2 is at 292, and then I would study the charts and put what my preference to sell it at, because I always tell you sell below the actual resistance. That got very time consuming, and so now I give you the actual resistance levels. It's just easier to put that there and let you then just decide to sell a little early. We came in shy of the trend line here today, and very well may continue up there. There's still some momentum in a lot of the cannabis stocks right now, including that ACB, which was also an official trade idea recently. This again, it was ACBFF, if I recall right, when we first started trading it, and had a beautiful trade on that one. Back, when it was a penny stock, it was one of my favorites back before there was even hype on the cannabis stocks, and when there was just starting to be, and that goes back farther than this chart will. Anywho, so that one hit T3 recently. That was the final target right there, or close enough. There's, within, I did say, 118, it hit 115. And I didn't have it. I told you, kind of dropped off my radar after I posted it as a setup and made a breakout. Never came close to exceeding a reasonable stop for those targeting T3 based on an RR, a good 2-to-1 or 3-to-1 RR ratio. And so that's it. So when you come that close to a price target, that's effectively, it's hit that resistance level. And there's an example of where traders will usually step in a little early if everyone's looking at that. So where am I going with Kara? Yeah, that's a pretty obvious trend line. And yeah, we could certainly get there. We could certainly hit these other targets, but it's a weekend coming up. It's another reason, who knows what's going to happen over the weekend. We have the semis breakdown today. We're a little off the highs right now. High of the day so far was 246. We're at 240, so I just want to point that out if you want to book profits. What are we at on that? That was entry was at 190 or 189, 190. Trying to zero in on that line I put there. Yeah, 190, and so far it's good for a 30% pop in just 2 days. So, sometimes take the money and run, or at the very least raise stops. But again, raising stops right now for a swing trader works fine intraday, but when you close at 4 p.m. Friday, a stop loss order, you have two types. You have stop limit and stop loss. Stop limit order says, let's just say you want a relatively tight stop, so you put it at 237, 236 right now, whatever it is. Stop limit says if it crosses down to 236, sell me out, but only at 236, no lower. And a stop loss says if it hits 236, sell me out, but it converts to a market order at that time. So the way this works, or that works, and this is important, I talk about this all the time. This is one of the most important aspects in trading. Number one, stops, especially if you don't have the luxury of being in front of your desk all the time like me, and you can do mental or stops in real time. But if you're going to set a stop because you're not in front of the computer all day. That stop limit again at 236. Let's just say if we gap down, and we could gap down to 235. The limit order has been the triggered. Sorry, the stop part of it has been triggered on a move down or at or below 236. However, the order instructs to fill at 236 or better. So it can fill at 237, 238, but it cannot fill at 235, anything below 236. So if the stock opened at 235 in that example and then just went down from there and that was the end of the run, you're still standing left holding that position, the full position. That order didn't execute. Whereas a stop loss order, the stock opened at 235, which is a penny below 236. It'll instantly at the opening bell convert that stop loss order, then converts into a market order. And it's going to fill you at any price. So if it opened down at 236, you'll get filled at 230 or 235. That's where you get filled. If it gaps down to $2, you're going to get filled at $2. So that's what a stop loss. That's the difference there. Very important to know. And remember, on stop orders, things like that, you want to use that. Make sure you mark it good to cancel, not a day order. If you're going to keep a swing position on. Okay, I already got you out the updated charts on wheat this morning. Just gave you a new initial target. We've been swinging the last. We had this one here. Got out T4 at that level again. Divergent high, divergent low. Simple stuff. This is really a wash, rinse, repeat type chart. So far, so good. At this point, we already put in divergent low. We've been moving higher. We made a marginal new low under that low. So, stop should be somewhere in there. And again, these are just initial targets. There's the potential for more if we get going. We are still in an inflationary environment. The Fed has declared the war pretty much unspoken, obviously, but in the mainstream media has declared inflation a thing of the past. And we've turned the corner. That's what I've read. And we'll see. Crude oil certainly says otherwise. USO. Oh, by the way, still, I've tweaked that uptrend line ever so slightly. Remember, recently I had a bearish rising wedge on the 60. We still very much do. So I still maintain my bearish outlook. Just waiting. Need to see this wedge break again. I modified the trend line ever so slightly to fit these last two recent reaction highs. There you go. And this is now S1. It's 78.88, meaning support. For support, you could take a. If you short it now and it goes down there, you could certainly take profits there, but that's only 2.5%. So I'm going to maintain that original T1 down there, which would be about a 4.5% drop. T2 is going to be about a 7% drop, and we'll see if we add any more there. Silver, I like that one. It's actually, I got an update out to you today on that. What else do I want to show you? Kind of going back to QQQ here. There's that downtrend line I gave you on the daily right there. You can see it well on the 60. It shows very well here. There it is, nice and clean. So 60-minute chart. Boom, boom, boom. And there's the primary uptrend line. So we're right there, guys. Yeah, so we'll keep an eye on that. Semis are broke down. QQQ is at support. And the VIX is starting to wake up today, coming off a divergent low. These are the VIX futures. This is the October contract. They just rolled. There's still a few more days left on the September. Those will trade till, I believe, the 20th. So these are the October contracts. And, starting to move. And we're getting even more movement on the Septembers today. This is the VIX spot index. Again, you can't trade the spot VIX. You can only trade futures, which I just showed you on that, or options that trade on those futures, or you can then buy an ETF, or technically it's an ETN that invests in those futures, and they have those, some that roll the short-term futures, and then others that roll the intermediate or midterm, go out a couple months, and so there's all kinds of flavors to the VIX, but this is a spot VIX. And really nothing's changed lately. We continue to build these big divergences right here. The purple line, there's our divergence line. We had slightly lower lows recently. You have to zoom down to a 60 to see that, probably a little better. That's it. And so, and most recently, this is what I just showed you on the futures there. You had this little most recent divergent low right there. And so, it's all there. If we gap down on Monday, On the Qs, of course, SPY also matters too, but like I said, I'm much more focused on QQQ. Market has lived and will die by the Qs, in my opinion. It's lived by the Qs this year. And, it was the Qs that took it down last year. They fell. When I say the Qs, I'm talking about the NASDAQ 100. But the S&P will follow. And there's a lot of other sectors. That's the thing about it. Before it was all about tech. This whole thing, really, since the highs, since the bear market started, I'm still referring to it as a bear market. Kind of just really a correction. What we saw in 2022, even though it met the definition. It's the old antiquated definition, not my definition. A 20% move in the index has long since been an antiquated measure. Every security is different. If you call a 20% rally or drop in natural gas a bull or bear market, well, guess what? Sometimes you get those in a single day, especially over 2 days. I've seen many times natural gas go up or down 20% in 2 consecutive days. Does it all the time. So, you have to just take every index, every sector, every stock, and just kind of put things into perspective or relative to how much they move, and also relative, like long term. I go to a monthly chart, weekly chart, and this is it. So I still have a lot of primary bull market uptrend lines in the NASDAQ 100 that are intact. And so when you look at it this way, it's just a, correction. And what I believe to be, however, the first leg down in a bear market with much more downside to come. Remember, a few weeks back, I mentioned we had the bearish crossover on the PPO right there. So far, we're down there. That's one type of sell signal. And I already covered this part here. Oh, yeah, I wanted to go to the S&P 500 for you and see if I have any of the boards that matter. Okay, this one, it's messy. Sorry, I didn't, I'm kind of ad-libbing this part of it. I have a lot of other boards, and I know in the future, so I guess this is the one I want to show you right here. Yeah, that's it. This is a clean board. There we go. On the daily, it's not shown here on the 60-minute chart, which I just jumped over to. We had, remember, I'll show it to you, a bearish engulfing candle, and that marked the high, and those are pretty significant potential topping sticks and bottoming sticks, just like we had a bullish engulfing candle there on the S&P 500 that marked the bottom back in mid-October and gave you this rally. And so I'm still going off the primary scenario, my primary scenario, that this was the high, the end of the bear market rally, and then we're going to stair step down and things really start opening up the floodgates when we take out those lows from August 18th right there. Okay, briefly lost internet connection there, but let's see here. Okay, so this is the near-term uptrend line in the S&P 500. This is my clean board. So it started here. This was the first sell signal that came when we had right at the top, right after that bearish engulfing candle I showed you on the daily. We had negative divergence. It's, not always. All my boards don't have it shown here. That's actually, we're diverging. There was our divergence lines right there. So that gave us a bearish rising wedge. There was the bearish engulfing candle itself was a sell signal once we had the follow through after that. Then you had a break of the wedge right there, sell signal number 2, sell signal 3 on the breakdown of that secondary trend line back test. That's also an objective short entry. And we're here right now. This is pretty decent support, about 443.80. We'll call it 443, round it down. And then this level here, that's why I have that red, color-coded red. That's that August 18th low. And, of course, this was the trend line that's red on my daily chart, or I should put it there, 433. So that's what needs to happen to kind of give us that, what I call all-in short moment. But I think it'll happen if QQQ breaks down. I think it's just going to bring the SPY down with it. Now, on that, again, I told you I'd kind of be all over the place. I've been short and highlighting the home builders as objective short since back right here, I believe it was August 4th, right after they broke down from this bearish rising wedge. I know I gave you an update on it today, but I just want to talk on them a little bit more. So we broke down, back tested, rolled over. That was sell signal 1. Then we broke the primary uptrend line right there. That's a beautiful uptrend line. Lots of hold on, let me mute my speakers here. Okay, sorry about that. I have internet keeps jumping off and out. I don't know what's going on. That's common in this area. Comcast is just abysmal, but there are really no options down here where I'm at. Okay, so breakdown, back test, moving lower, and this is what I showed you today. That was the second price target there, and we're cracking just below it now. A lot of individual home builders have already broken down, and quite a few others are at support. Remember, ITB, you can use XHB, but this is a little more weighting in the actual builders themselves and the building material stocks. You know, they tend to move together. What building materials are fasteners, which are, for those not familiar, it's screws and nails and things like that. Those are in there. Paint companies, Sherwin-Williams, the biggest one, and things like that. And they tend to follow the home building stocks, and rightfully so, right? If they're building more homes, then they're using more building materials. Simple stuff, right? So that's it. So we need to take out today's lows because we've had two spike lows down to this level. See right there and there? Take that down, it should open the door to T3, T4 zone, T5, and maybe more. What I wanted to mention, there's a lady out there. What's her name? Melody Wright. She really knows her stuff. She's, when it comes to home builders, and she's had some compelling videos. You can check her out. She has a YouTube channel and probably a Twitter feed and all that. But pretty much talking about how, she doesn't use the word cooking the books, but how they're fudging the numbers and just creating this false guise of an extreme shortage of homes. And while, and which has been the narrative that's driven these home builders up. But supposedly they have a lot more inventory than they're making it appear. And it just has to do with how a home, until someone moves in, takes possession, then the home's marked as occupied. But they can have, tons of spec homes in a property, how they actually use these they go so far as to put garbage cans out in these communities they're trying to sell homes, even though the homes aren't sold, to make it appear they are, to get buyers sucked in. And they can even develop huge parcels, build out a whole development of homes. But if they haven't yet sold them, on their books, those don't count as, even though they are homes that could turn around and sell anytime, they can count that as just a property or land. Until they start selling those off. So anyway, it's interesting. And again, I was impressed. This lady knows her stuff. And so now I've just came across her recently in one of her videos. But it only reaffirms what I'm seeing here in the charts. To me, you can sit here and sit down with me, and I don't care if Jamie Dimon sat down with me and convinced me to short the banking sector, because it's going to go and take it on the chin. If I can't see it in the charts, I'm not going to do it. So charts come first and foremost. And the same case I've been making on these since early August. It's not only intact, it's playing out. It's what it's doing. So this is, again, where, if you're trading the stock market, then you're kind of going around in circles. But on this, I wasn't saying short them here. It was right here that's where I started highlighting it. And now the next short entry is about to come. So everything's lining up, guys. That's kind of the takeaway from this video. QQQ, we're still in that range. We're still above trend. And yes, support is support until and unless broken. And yes, buyers could very well come in and buy it up. But the fact the semis broke down today, that's big. QQQ's right on the line. The home builders are already broken down, already in a downtrend. They are one sector that's clearly in a near-term downtrend, defined by security making lower highs and lower lows. And now when they do that, that's going to reaffirm it and probably see a pretty quick swoon down to T3, the next target there. And then if and when that goes, and that, by the way, is only more of a minor support. I don't expect much of a reaction. There's a reaction high there, a couple candles. I wouldn't be surprised if we had very little, if any, reaction and went on down to that fourth target zone there, especially if the market breaks down next week, QQQ, and we see follow through on the semis. Okay, let me just wrap it up here. A few more things. We're still there. There's been absolutely no reprieve, which also plays into the home builders. I talked, a while back, I came across an article, I believe it was in the Journal of Barron's, about how the home builders, were reporting these rosy numbers, and they were trying to hold up keep prices up, although their demand had really been slumping. And so what they were doing to keep prices up, because it's a vicious cycle. I've mentioned this before. If they start cutting prices, that has a domino effect in the housing market. And so what they were doing is subsidizing mortgages, buying down people's rates, which costs them cold hard cash, eats into their profits, and they were throwing in a lot of extras and upgrades and things like that in order to keep the price up. But those are incentives. If you have a lot of good demand, and the home builders are coming off a very hardy run, then that's not a good sign. So they shouldn't have to be doing that if they had such good demand in this shortage of homes that they're trying to portray. So it makes no sense. They're going to get whatever the top dollar they can get for selling a home, and if there was that huge demand that they can't even meet, they're not going to give you concessions. It's just how it works. So there it is. So no reprieve in the 10-year as well. Inflation, like I've said, the market is playing a game of chicken. It is ignoring the fact that crude oil and Treasury bond rates, or interest rates, are pushing back up to multi-year highs, right at it, testing and even threatening to break out. And so don't fall asleep at the wheel. From slow, sideways, boring markets often come some big moves. So maybe it happens next week, maybe next month, maybe by the end of the year, maybe not. But you have the levels to watch, the developments to watch for. And let me see if there's anything else I want to show you before I wrap this up. Oh yeah, Carvana, beautiful trade idea here. Look at that big reaction high there. We had a reaction high there. I put DH. I can now take away that question mark. I think I might have shared this one with you recently. If not, we have an equal high, negative divergence. All you need to have is equal or higher highs in price, and that's an equal high if the indicators are making lower highs, and that's what's happened. So we have negative divergence, and again, we could go up a little higher, be a marginal new high. If we do, what you do is you don't necessarily short the breakout above that level, because that would be a breakout. You can wait and short the failure back down below it if that happens. So I'm giving you this one. I think I know it's objective here. Obviously, that's kind of a subjective opinion, so I can't say I know. I guess I should say I think it's objective to short it here, right at that 58-ish resistance right there, with a stop somewhat above. But the stop would need to allow for a false break, a breakout that is marginal, not too far above. Like I said, any breakout will simply extend this negative divergence, but we may not get that. Like I said, the market's walking on a fine line right now, and we can break down. So a lot of meat on that bone. These are targets down here. You can see T1 through T5. The rest of the dealers, they've just already long since broken down. There's cars.com, sell signal on the break of the bearish rising wedge, hit the primary trend line, then we took the trend line out. We just took out 1760 support. These guys are falling. Carvana is going to play a game of catch up to the downside. There's CarMart. What else? I already showed you ITB today. I already showed you the semis. I'm just clicking on my things to watch list. Moody's, I've got a lot of stuff in here. Breakdown, back test. This is bond insurer. These are all the things to watch. Caterpillar, I have that in there. CarMax is ready to fall out of this trading range. Hasn't done it yet, but if it does, that's going to be a short trading opportunity. Retail stocks, again, what's the stock market doing? What's QQQ doing, testing or challenging new highs? The tech sector, if this is the tell of the economy. You look at XRT or retail companies, Amazon, Walmart, Costco, TJ Maxx, Target, O'Reilly, AutoZone, Ross, Kroger, Dollar General. I'm just looking at the holdings in your Dollar Tree, Tractor Supply Company, et cetera, et cetera, et cetera. So there's a disconnect with what a lot of sectors are saying and what the market's doing. And again, the stock market, in my opinion, playing probably one of the biggest games of chicken I've seen in many years. with interest rates and crude oil and energy prices threatening to break out the new multi-year highs, even take out the previous highs. That doesn't make sense that the stock market and energy, with inflation being the biggest thing right now, the biggest impact on the markets, what the Fed's going to do. So one or the other, either crude and interest rates, everything's going to fall, and it's going to fall in an orderly fashion that allows that another leg up or a resumption of maybe a new bull market in equities. Yeah, we'll see. I don't see it right now, but it's possible. A couple others, AGO, another bond insurer there. Breakdown back test, objective short entry right here. This thing, my targets would be, there's a couple along the way. I can give those to you now, but maybe catch a little support here, but I'm calling this one down to 45. You have resistance at just above 63, so it's an objective here. Stop above that would give you about a 6% loss or downside versus a gain of about 26% to the downside. Very nice RR in my opinion. AMBC, and you may want to wait till the market buckles. This one we shorted way back here. Hit T1, bounced as expected, right into resistance, gave you another objective short there. Hit T2, bounced, hit T2 again, finally took T2 out. Support is support until unless broken, now and then it becomes resistance. So that it's back testing the $13 former support resistance level, should take it down to T3 and then T4. This also is another bond insurer, which brings me to another thing I've been watching. There's a lot I'm watching. Paychecks. Okay, so here's our whole, probably the single best narrative, because retail sector's already rolled over. I just showed you that with XRT. And we know that retail sales have been slowing. Most of the retailers have come out and said the consumer's pulling back on big ticket items. They're budget shopping. They're going to Dollar General. They're going to Walmart, and they're buying they're buying necessities now, they're buying things that they need, not things they want. Some more the staples versus discretionary goods, right? And but here's paycheck. So other than the retail sales, which is kind of rolled over, clearly as indicated by the charts, the one thing, and it's something. And by the way, it's a big thing that the ardent bulls have to hold on and cling on to is jobs, payrolls. And we've seen that's been ticking up. The jobless rate and claims overall, the trend has been ticking up. And watch these guys here, Paychecks and ADP, I'm sorry. Watch those guys. Paychecks just broke down. I showed you some objective short. Here's ADP. There's your uptrend line, wedge right there, divergent high. I highlighted it. Excuse me. I highlighted it back here recently, and I told you this is simple stuff. You get overbought, boom, 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 boom. Especially overbought with divergence, because a lot of times that first overbought reading will take the stock down, but it's that second one with the negative divergence. That's what we have there. So if ADP goes down, and here, I'll do it for you. I usually say you can do this yourself, but it's easy. Okay, ADP in the stock market go hand in hand. I'm going to compare it to the S&P 500. Boom, you can see it there. Clear as day. All right. And so what you're seeing is, again, the stock market, it's kind of been floundered. It's not going up anymore. Peaked right here, but so did ADP. And if ADP breaks down, you can use that as a predictive indicator for the stock market, simply by knowing that. This is I believe the biggest payroll company right here. Most of you probably know it. Your paycheck's probably ADP on it. You probably go to TurboTax if you're doing your own return and download everything, all your information from your W-2. LQD, the other things I'm watching, corporate bonds. I think this is a big one to watch. I've read that in recent years, and it's huge. I wish I had the stats on me, but let's just say going back 15 years ago, whatever, it was something along the lines of the lowest investment grade bonds are triple B. Anything below a triple B is considered a junk bond. And that would be in JNK or one of those junk bond ETFs. So, so going back, what was it, 15, 20 years ago? And again, don't hold me to these numbers, but it was maybe 20% of the debt in LQD, the investment grade bonds, in the investment grade bond market as a whole, were triple B. Most of them were, you had double A, single A, AAA, double B, single B rated. I'm sorry, no, it has to be triple B or above. So you had a lot of A-rated bonds, A, single A, double A, triple A, and then you triple B. Now it's somewhere, and again, don't hold me to the number, I think it's like 80 something percent. It's a very, very large number of issuance, debt issuance in recent years has been in that lowest minimal tier, which is triple B rated. Again, and so what does that matter? Okay, in a dime, in a heartbeat, if this economy takes a turn, a lot of these companies, we know it's coming. They're going to have to roll their debt. A lot of corporations were locked into these low rates for a while, but we have a tremendous amount of corporate debt coming due between now and the end of next year, into 2024. And so what does it matter? Those companies' debt ratings are not fixed. When you're a corporation and you sell a bond and you're rated by these rating agencies, that rating is subject to change. And when economic conditions change or conditions for that particular company, they can get downgraded. And then what happens is when they get downgraded, there's a domino that triggers this bond ETF, LQD, as well as a tremendous amount. Remember this, please. The bond market's much larger than the stock market. There's a lot more dollars in bonds than in stocks. And everyone's 401k is chock full of them. You have them there. There's bond funds galore. And so what happens now is if it's a bond mutual fund, or in this case an ETF, a bond mutual fund has a prospectus, and the prospectus says what that manager or the management team, what they can hold and what they can't hold. And a lot of the bond funds out there are investment grade only. They call for holding, investment grade bonds. So what happens is when you get those downgrades, and if they all hit at once, and it could be a vicious cycle there, they have to be sold, and then that puts selling pressure on the rest of them, because the bond fund manager, can no longer hold junk bonds. They're not allowed to. It's prohibited by the prospectus. It must be investment grade. Now they might have a little time frame in there they're allowed to hold before they sell them. But anyways, so that's a big risk there. We saw it back here before. LQD, people think that they're safe in government bonds. In investment grade corporates or even government bonds. And in most points in time there are. But again, these are special situations, what I just talked about. Things that haven't historically existed in the past, where you have just a huge shelf of low quality, again, minimal, it's still considered investment grade, but right on the fringe. And that could really, really roil the financial markets if we see a mass downgrading of a lot of corporate debt. Alrighty, what else? And you'll see that in Fallen too, and UPS, or these are the ones I told you I was watching the other day. UPS, FedEx, bellwethers, economic bellwethers, massive support there. I have a price alert set up under 154.90. It's pretty much lights out for UPS. And again, it's lights out for the stock market. There's another one. Again, you can do it yourself. It's already overlaid here. Okay, so this, you roll it back. Remember the blue line I put on before, that's the S&P 500. And you can see there is a unmistakable and pretty much immutable positive correlation here when you look at the stock market and UPS. And because, again, these are probably two of the UPS and FedEx, the most straightforward, indicators for the economy. When the economy is growing, they're doing well. People are shipping a lot of goods and products and documents and other things like that. So what's going on here lately? Well, okay, the stock market and UPS, they were both rallying for a while here, but UPS is coming down hard, a lot harder than the stock market. The stock market's ignoring a lot of, again, what I've referred to as yellow flags lately. And you can see it with FedEx as well. FedEx not as much, but rolling over all the same. And here's your uptrend line. So FedEx just broke this first uptrend line here, and it's back testing. And so based on that tells me the next stop, likely because we broke support and we're back testing, it's going to be this other potential trend line. This trend line is more valid. You have a lot more reactions on this first trend line. This is the one that counts. This is only a potential trend line, because I only have a couple reactions there. Really, this is the first good support. I have about 232 on FedEx. But again, it's a stock that's already broken down, and it broke down after putting in a divergent high. So that's about it. DIPT, divergent high, needs to break that trend line. We had this one as a trade idea earlier in the year. We shorted it here, hit our first and second target. Never made it to my third target. Bounced, but just like the stock market, had a kickback rally, which I think it's still going down to that target, and needs to break this trend line. So there's a trade idea for you. Set a price alert or replicate that trend line, and you can use the same. That was T1 before, but T1 already got hit, so did T2. So I'll be honest with you, I'd probably just hold out for for the prize there. Drop down to $10. That would give you from where it breaks down. If it breaks down soon, that would be about a 40% gain on that trade if you short that one. JP Morgan already broke down, bounced off that 143.85 support, but still below the trend line, right even to the breakdown point now. So there's another objective entry. You can short a kickback to the breakdown point, or a back test of the trend line, or an impulsive rejection off the back test of the trend line if we get that. The last couple things I want to point out, something I've been watching closely, is California. I'm on the other side of things. I'm here in Florida. We're a whole different ballpark. We don't have a state income tax. California has one of the highest. California is most you probably know, it's probably the wokest of all states in the union, and one of the in my opinion, I'm sorry to speak this way, I don't mean to be offensive, but one of the more idiotic things, and California is known for those, is passing that mansion tax recently. So I'm sure if you live in California, I'm sure you heard about it. They're just running out the in California, what is the 2% of people pay all the taxes, and those people, they're just getting fed up. They're just getting fed up with the unproportional burden they have on state income taxes. You've got CalPERS, the largest public pension fund, grossly underfunded, and again, in my opinion, will be one of the big things to come in the not so distant future, what I call the pension fund crisis, when these plans have been underfunded for decades now, and with the whole 80-20 thing blowing up and their underperformance. Where I'm going is that burden falls on the taxpayers. Any unfunded liabilities for CalPERS, again, falls on the taxpayers. So I've been watching California bonds, and this is one of many. You can go and type. There's other ETFs. PZC is the PIMCO California Municipal Income Fund. And so what I want to point out, you can see besides the fact we just took out, I had a little uptrend line here off the lows right there. That's been taken out. We're now coming up on the lows. Remember, when the stock market bottomed, so did most bonds back here, treasuries and munis in mid-October. We're right now coming up on those lows. Okay, why is that a big thing? Well, number one, it is just because it is. That's a huge technical level. But more so, when I look and compare, MUB is one that I've always charted. It's a general national municipal bond fund ETF. So remember, I used to do this for a living. I used to be a stockbroker, financial advisor, and sell muni bonds. And the way it works is if you have a resident in California, I would find them California muni bonds because that exempts them from both federal income tax as well as that hefty state income tax. However, if you, Florida client, or myself, if I wanted munis, I'm going to buy the national one because we don't have a state income tax. So you don't need, Florida does issue municipal bonds, but there's no state income tax to avoid. So therefore you use a national municipal bond fund that picks the highest paying bonds from whatever states they are. Okay, so this kind of gives you a broader view of what the muni bond market is doing. And just like everything, it bottomed, around October, mid-October. So put in a divergent low there, at a marginal new low in November, and that's where it bottomed. And look at this. Remember, this is a bond fund. It is at very good support. There's a line right there. However, it's well off the lows. So what I'm showing you is there's a problem in California. Their bonds are now significantly lagging other comparable municipal bonds. And so anyways, it's in my TTW things to watch list. I'm sharing that with you. And again, those are the things to watch. I have no desire to short muni bond. You short a bond or a bond fund, anytime you short something, you're responsible to pay those dividends. I don't short. Plus, bonds hardly move. I'll trade Treasury futures, but I just wanted to point that out more as a kind of, hey, what's going on there? Because not everybody, but myself and others, to me and many others out there who I respect, it's not a matter of is another shoe going to drop. It's where's that next shoe going to drop. These rate increases already broke the banks. We had the two biggest bank failures, two of the biggest in history, and three big banks all went down. Of course, Fed came in and saved the day there, put the plugs. But that was in my opinion, a lot of others, just the first thing to break. And so this is one of potentially other things, and just watch it. So I'm going to wrap it up here. This went to, I'm at 56 minutes. All right, it's longer than the video I did yesterday, but I did the same kind of thing. I just went on ramble looking at things I'm watching, and all this stuff's intertwined. That's why. All right, I'm going to wrap it here. I'll get this video out to you. And again, if you're a glutton for punishment, you want to listen to the one I did yesterday, let me know. I'll post a link for you. This has been Randy Finney with Right Side of the Chart. Have a great day.